Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video. This is a video series we started some months ago, and this video series is designed to add value to and complement the Undervalued Dividend Growth Stock of the Week series, whereby twice a month right now we're picking some of the recent Undervalued Dividend Growth Stock of the Week articles, and we're picking them apart. We're basically taking this time to make a video and break down the article, discuss where I came up with all the numbers, discuss where all these ideas are coming from. When we come up with a bottom line, we come up with a valuation. This video is designed to actually break everything out and show everything in real time as I shoot this video, as you guys, as you viewers and as you readers follow along, where I come up with all these numbers and where all these conclusions come from and everything else. So of course, as we've talked about in prior videos, if you're new to this, this is the Undervalued Dividend Growth Stock of the Week series. Every Sunday I publish what I believe is a compelling long-term dividend growth stock investment idea that has to pass a number of different hurdles. First of all, it has to be a dividend growth stock, which means I source it from David Fish's Dividend Champions, Contenders, and Challengers list. So that's the first hurdle. The second hurdle is that it has to be a business that's high quality in terms of quantitative and qualitative analysis. So you're looking at certain fundamentals, business growth, good profitability, good balance sheet, so on and so forth. And then you also want to make sure on the qualitative side that there are durable competitive advantages to more than offset any risks that you might consider. And then the third hurdle, of course, is valuation, which is perhaps more important than any of them, or at least just as important. You want to make sure that even a great business, if you pay too much for it, it's probably going to be a poor investment, at least over the short term. So you want to make sure that you're paying a good price, i.e. you want to buy that high quality dividend growth stock when it's undervalued for a number of different benefits, which we go over in the articles and which we'll talk a little bit about in the video. So of course, it's the Undervalued Dividend Growth Stock of the Week series. I've already got it pulled up for the video today. If you guys are at dailytradealert.com, you go over to the Dividend Growth Investing heading there, click on the Undervalued Dividend Growth Stock of the Week tab, and you'll see every Sunday, going back to 2014, there's a dividend growth stock that's presented to the investment community as an idea that at the time, it seems to pass all three hurdles. And obviously, there's varying degrees there. The higher the quality of the business, if you're looking at an extremely high quality business, then the undervaluation there may not be as strong as maybe a different business that maybe has more risk, maybe the competitive advantages aren't as strong, but you're getting maybe a deeper value. So I try to mix it up every week. Some of these ideas are deep value where you're looking at maybe 20, 30, 40% possible undervaluation, but at considerable risk, and maybe the business isn't as strong as some other ideas. And likewise, in other weeks, I'll present something as just a really super high quality business, something that just, you sleep well at night, you buy the stock, you lock it away, you keep it for a generation or two, you never really think about it, you just collect and reinvest those growing dividends, but the valuation may not be as strong. So each week I try to present something a little different. I also try to mix up the sectors. One week it might be healthcare, another week it might be something on the consumer side. Energy is going to be in there. So again, try to mix it up every week, present different ideas to you guys, and that way I feel like there's a different stock for every kind of dividend growth investor out there. Of course, keeping in mind that I personally invest in the vast majority of these dividend growth stocks that I'm presenting every week, but you can see the full archive here if you click on that tab. And I'm going to click off that because for this week's video I selected Metronic, which as of the shooting of this video, which is December 20th in the afternoon, that is the most recent Undervalued Dividend Growth Stock of the Week article that's been published on Daily Trade Alert. So I'm going to click off the archive here, which pulls the article up. You can see it was published on December 17th, so just a few days ago. And again, guys, welcome to a video. I'm excited to kind of break things down for you guys. It's always a real pleasure for me to do these videos. I'm shooting this live from Chiang Mai, Thailand, which is my home, and it's just a real pleasure to be in this position in life. I'm humbled and honored to be able to present these ideas to you guys. Getting back to the article, every Undervalued Dividend Growth Stock of the Week article, every article that I shoot starts out with what I call a big idea, which is basically when you pull this article up, when you start reading the article, be you new to the series or maybe more experienced with the series, or even if you've been following along since 2014, every article starts out with a different idea as to why you should be investing at all, number one, and number two, why you should be interested in high quality dividend growth stocks. What should make you start to think differently about your capital? What should make you start to think differently about certain lifestyle decisions? Where you value perhaps spending and investing, or you prioritize saving and investing over spending, where you prioritize experiences over stuff, where you prioritize time over money, where you start to create these shifts in your life that will eventually lead to a lot more independence, freedom, flexibility, and opportunities in your life, and very most likely happiness as well, as I've personally experienced. What can create that paradigm shift in your mind? And so every article is designed to kind of look at that paradigm shift, and every article is designed to kind of inspire you and motivate you from a slightly different angle, using a lot of kind of age-old concepts, and I kind of put my own spin on things. And in this particular article, I start out with basically the idea that there are a lot of ways to make money in this world, right? I mean, as many different people as there are in the world, the billions of different people, there's probably billions of different ways to make money as well. However, there are also a lot of ways to go broke in this world, and that's a key thing to keep in mind. So if you're not interested in dividend growth stocks, that's fine. That's no problem. It doesn't benefit me in any way if you follow me along and invest in the same stocks I do. It doesn't really positively impact me in any way. So I'm not trying to convince anyone here. I'm basically just trying to help, inspire, and motivate. But if you think, dividend growth stocks aren't for me, I'm going to go over here to this other idea, that may be fine. But just keep in mind that while there are a lot of different ways to make money and invest your money and try to earn a buck off a buck and everything, there are almost as many ways to go broke. And the unfortunate part of that is that a lot of different business and investment ideas fall into both categories simultaneously. And I kind of relay a personal story. This is a true story that happened to me recently here in Thailand. I was riding what we call a red car or a songtao across town, which is kind of like their version of a bus or public transportation. It's loosely analogous to what you might find in the States as far as like a bus or a train. So we were on this thing, and I was talking to a couple guys, and one of these guys was an older gentleman, and he was talking about, I couldn't really tell from the conversation if it was a friend of his convincing or maybe talking to him about this idea, or if he was personally going after this, or if it was his idea. But the conversation kind of evolved into this topic where there were this guy and his friend, or maybe this guy solely, or what have you, they were interested in investing or opening up a bar here in Thailand, investing in one or opening one up from scratch or what have you, or buying one out or whatever. And I'm kind of being not clear on that because the guy wasn't real clear on it either, as you might suspect, which a lot of people are when they start talking about investment ideas on a public transportation thing, or, oh yeah, I'm thinking about doing this, who knows. But at any rate, I'm kind of listening to this conversation, not maybe intently or anything or super closely, but I'm just I got my ear on it, kind of vaguely interested in what the guy's talking about, and it just automatically kind of popped in my mind that, yeah, sure, he could make money on this thing, and maybe they open a bar and it's successful, but also maybe it's not successful at all, and maybe it closes, because I've run into a number of bars here that are successful, and Thais or expats visit them regularly, and they're packed and they're jamming, they got music, and there are a ton of them that were open at one point, obviously, and have long been closed, or there are a number of them that are clearly going to be closing soon. So, maybe you make money on something like that, and maybe you lose all your money. I just don't get why you would want to play that game. This is what I talk about in the article. Why play that game is a good question. Why get into something where, yeah, maybe you can make a lot of money, but also maybe you could lose a lot of money? Why do that when instead you could put your capital to work with high quality businesses that have a demonstrated track record of being very good at making money for shareholders, like me, potentially like you. And not only are they very good at making that money, but they're very good at directly sharing that money with shareholders, because shareholders are ultimately, effectively, the collective ownership of any publicly traded company. So any profit a publicly traded company generates is therefore, thus, technically the shareholders' money. When I invest in Coca-Cola and they generate a profit, that's my profit. Now, a very small slice of it might be mine based on my ownership of Coca-Cola, which is obviously quite tiny. Nonetheless, though, it is my fair share, and I want my fair share, and that's where the dividend comes in. And as that profit grows over time, thusly so should the dividend. So that's kind of the big idea we talk about in the article, and of course I linked to David Fish's Dividend Champions, Contenders, and Challengers list, which is talking earlier in the video, where every stock is initially culled from for this series. And Mr. Fish, compiles data, an invaluable amount of data, on over 800 US listed stocks that have paid their shareholders increasing dividends for at least the last 5 consecutive years. And I also link to my real money, real life 6-figure dividend growth stock portfolio, which is a real portfolio that I started building in mid 2010, and I haven't really been aggressively adding to it since about mid 2016, just due to the fact that I have kind of other priorities over just aggressively saving and investing as much money as I can, because once I reached financial independence, which was around mid 2016, sometime in the spring there, around March, once I kind of hit my goal, which was to be financially free and be able to live life on my terms, then, you know, aggressively saving and investing isn't quite the priority it was. So the bulk of the portfolio was built basically in a 6-year stretch. I continued to invest a little bit every single month, but some other things like philanthropy and things like that just really have kind of become more of a priority for me in my personal life. So nonetheless, though, this is the portfolio that generates the 5-figure passive dividend income I need to basically live. And I live here in Chiang Mai, Thailand, which is one of the cheapest places in the world to live, but also simultaneously, surprisingly, one of the highest quality places to live in terms of quality of life. So it's a really wonderful place for very low cost of living. So my dividend income, although it is just barely in the 5 figures, we're talking, you know, over the course of the next 12 months, I should be earning around $12,000 in passive dividend income, or perhaps a little more than that. That doesn't sound like a lot, but here in Chiang Mai, Thailand, it's actually like a middle class income. It's actually quite a bit of money, and it can afford you a very nice life. If you can't tell by what you see behind me, I live in a small apartment, but it's a very nice apartment, fully furnished, includes Wi-Fi. I get cleaning, I get a maid service. It's got a beautiful view right outside, overlooking the city. I'm steps away from the most walkable and trendiest part of town. There must be 100 restaurants within 200 to 300 meters of my apartment. I mean, it's crazy. So so getting back into the article, kind of talking about, and the reason why I link to my portfolio and the reason why I use my personal experience in these articles is because I personally benefited from this stuff. So when I advocate, you know, these stocks, when I write about these high quality dividend growth stocks, it's not just, you know, some idea I have off the top of my head. This is because I personally experienced the benefits of investing in these stocks, saving, you know, living below my means, saving my excess capital, investing that excess capital into high quality dividend growth stocks. I personally went from below broke to financially independent in, you know, about 6 years. So when I say that this stuff works, I'm not just some random guy out there, you know, with who knows what he's doing and who knows what he's actually investing in, who knows what his personal financial situation is. I'm actually, you know, I'm walking the walk. I'm not just talking the talk, and I linked everything. I talk about what I've been doing. I talk about how this stuff has benefited me personally, and because it's benefited me so directly, substantially, and beneficially, I find it almost, I'd be remiss if I didn't take that opportunity to try to inspire and motivate others to also become more financially independent, free, flexible, and happy in their lives and everything else. So getting into the stock today, of course, a good chunk of every article is devoted to talking about valuation and why you shouldn't just be looking at high quality dividend growth stocks. As wonderful as dividend growth stocks are, as beneficial as they have been to me, and as great as many of these businesses are, you can't just go buying them randomly. You know, again, you have to make sure those initial hurdles are cleared in terms of it being a dividend growth stock and in terms of it being a high quality business at that, via, you know, fundamental analysis and looking at the qualitative side of the business as well, considering, you know, risks and how much those offset those qualitative aspects. But you also want to make sure you're paying the right price. Because if you have a great business and it's worth maybe 40 a share and it's currently priced at 80 a share, well, you know, maybe a great business and all, but if you're paying that much more than what it's worth, you know, you're really putting yourself behind the 8 ball, and you're really hurting yourself. I mean, you're kind of shooting yourself in the foot, because you're going to limit the amount of income you're going to collect, both in the current terms, both in the near term and over the long term, in terms of aggregate overall total income. your total return is going to suffer. You're just adding a whole lot of risk because you're investing way more capital than necessary, and you could very well watch that capital start to slowly disappear as price and value more closely realign with one another. So we talk about undervaluation, and basically the main benefits are thus: an undervalued dividend growth stock should offer a higher yield, greater long-term total return potential, and less risk, and that's relative to what the same stock might otherwise present if the stock were fairly valued or overvalued. So and how that works is, first of all, price and yield are inversely correlated. So all else equal, a lower price will result in a higher yield. That's just simple math there. So, and that higher yield positively impacts one's potential current and long-term aggregate passive income. So you're looking at potentially not only more income right off the bat, almost immediately, as soon as that maybe that next dividend is paid, but that's also affecting the dividends you're going to earn for potentially forever, for the life of the investment, as you reinvest and as you're collecting dividend raises off of that higher yield. So that is a major shift in how that dynamic plays out in terms of your passive income over the long run. And of course, that positively impacts long-term total return potential, because income is one aspect of total return, be it through dividends or distributions. So that's one component. The other component, of course, is capital gain. And that can also be given a boost via the upside that exists between the price paid and the intrinsic value. So again, getting back to that earlier example, if you got a stock worth 40 and it's priced at 80, that's going to totally misalign everything we're talking about here. But if that same stock is worth 40 and you get it for 30, then there's $10 worth of potential upside that exists between price and value, right? So if you buy it at 30, it's estimated to be worth 40 based on a valuation method. That upside, what that results in is $10 per share of upside that may actually manifest itself if the stock market more correctly reprices that stock. And over the short term, price and value may wildly be mismatched, may wildly not align with one another well at all. You can see stocks sometimes that are worth 50, maybe 51, 52 a share, maybe 48, 49, somewhere in that range, and that might be priced anywhere from 30 to 80. Over the long run, however, price and value do more closely correlate with one another. As I talked about in the prior video when I discussed Amgen, a high quality business may see its its intrinsic value kind of rise pretty steadily over the long run. I mean, there may be dips, in business cycles and things like that, but a good business, its value, its intrinsic value is going to kind of look like this kind of thing over the very long term. It's going to be kind of a slow, steady upward movement, maybe some dips in there and whatnot, but it's going to look like that, which is roughly going to correlate with earnings. Price, however, could be just like all over the place. Now again, if you draw a line, if you draw a line with value and say, okay, it was worth 40 a share back in 1998 and it's worth 90 a share today or whatever, and you draw a line and say, yeah, okay, that was a nice steady move up. And price, maybe you could do the same thing. You could say, okay, well, the first point, the first plot line, or the first plot point was here, and the last plot point was over here, and you draw a line and say, oh yeah, they align pretty well too. But the problem is that price doesn't work in that straight line. It's like this all over the place, and it oscillates wildly. Now, while the two may roughly correlate with one another over the long term, as that price kind of moves up as well, that oscillation can be wild undervaluation or overvaluation in the short term, because those oscillations that I'm kind of drawing out with my finger here, if you're looking at a long-term stock chart, could represent 4, 5, 10-year time periods. So that's something to keep in mind when you're talking about upside and downside and things like that. That upside that we're talking about here in the article with undervaluation should manifest itself over time, assuming the valuation doesn't crater, assuming something doesn't happen with the business. But it may take some time for that to actually occur, because the market isn't necessarily very good at, while it is very good at price and value roughly correlating with one another, the market is pretty good at pricing stocks appropriately over very long term. It is not good at all at doing that over the short term. And when I say short term, that could be anywhere from months to years. So just keep that in mind. And of course, when you're talking about undervaluation, you're reducing your risk. That should be pretty self-explanatory, guys. You're talking about introducing a margin of safety when you're buying much less than what something is worth. It's just like buying any other asset. If you have a house down the road and a bunch of realtors get together and they do some comps and they do some they bring out some professional appraisers and everything, and the house is worth $200,000. Which is riskier, paying $150,000 for that house or $250,000 for that house? Very, very clear which is less risky transaction there. You want to make sure that anytime you have a good asset and you have a rough idea of what it's worth, you want to get in as far below that as possible so as to reduce your risk, and so as to keep kind of a buffer there just in case something happens. Because while realtors could do comps on that house and the professional appraiser could come out and say, yeah, it's worth $200,000, you might buy that house and find out it's got this issue and that issue and this over here, and maybe the comps weren't as strong as they were, and maybe there was some kind of issue with some kind of water intrusion issue, and all of a sudden the house is worth 175. So you always want to make sure you got that buffer, that margin of safety to protect yourself against any unknown risks when you get into a business, or even known risks that you may underestimate, or maybe something that isn't mitigated as much as you thought it might be, so on and so forth. And of course, I linked to Dave Van Knapp's dividend growth investing lesson on valuation, which is actually a lesson that's part of an overarching series of lessons on dividend growth investing as a strategy, as a whole. And these investings kind of read like an online book, where you kind of read through each chapter, each lesson, and it's designed to educate investors, be you a novice investor, more experienced investor, on how dividend growth investing works, why it can be such a successful long-term investment strategy in terms of developing passive income and generating wealth greater than probably what you could generate through almost any other investment strategy out there in terms of stocks. And also how to implement it in your real life, how to implement that in your own financial plan. So getting into today's stock, it's Medtronic. It's a medical devices and technology company that develops, manufactures, and markets a variety of therapeutic products to hospitals, physicians, clinicians, and patients across approximately 160 countries. So this is a global healthcare firm. And the reason why I like global healthcare firms like Metronic, and I was talking about this with the last video on Amgen, is the bankable trend that is the world becoming older, larger, and wealthier. And that's a highly bankable trend that one can operate with a high level of confidence that's going to continue to play out over many, many, many years. Our planet's population continues to expand. Meanwhile, each new generation becomes significantly wealthier than the preceding generation, and this is all occurring as people simultaneously live longer than ever. And so what happens is, as you live longer, as there's more people, and as this greater number of people who are living longer also have more access to money, then of course they're going to demand high quality health care at a higher rate. I mean, if you're 60 years old and you have some wealth, you have some access to some money, and you have some kind of health issue that requires a Medtronic product to fix or repair or somehow mitigate, or you need to extend your life somehow or create a higher quality life due to some kind of health issue, it's not a discretionary purchase, especially if it's something talking about life-saving issues. It's not like, well, am I going to go to that restaurant or this restaurant, or am I going to buy that candy bar, or am I going to go to that theme park? It's not like that. It's I'm going to buy this product. I'm going to demand the highest quality product I can get because I want to live as long as possible. I want a high quality life, so on and so forth. So, and often these are life or death choices. So as I note here, it's not a discretionary purchase. If you want to live longer and or a higher quality life, and if you have the available wealth and or access to these products, you're going to spend whatever you have to in order to make that happen, in order to prolong your life and make it a high quality life. And that's exactly where a company like Metronic fits in. They've got leading positions across the likes of pacemakers, defibrillators, stents, heart valves, insulin pumps, and this positions the company perfectly to capture and profit from rising demand for high quality and life prolonging saving healthcare products. But this would sound like a lot of bluster if Metronic weren't delivering an increasing profit and sharing that increasing profit with its shareholders. Fortunately for us, it's not the case. Getting into Medtronic's dividend metrics, they've been increasing their dividend for 40 consecutive years. And where we get that number, we got David Fish's Dividend Champions, Contenders, and Challengers list, which you can find at the top of Daily Trade Alert under a Dividend Growth Investing heading. You scroll down to the tab for David Fish's list. We got Medtronic here. We've got their dividend data right here. And you've got the consecutive years of dividend growth right here, which is 40 consecutive years, which is really incredible. I mean, that stretches through multiple wars, terrorist events, political upheavals, numerous presidents, the financial crisis, the Great Recession, multiple stock market crashes. If those aren't good enough tests, I don't know what are. So, when talking about dividend safety and reliability and, kind of banking your financial independence on the type of company that that can continue paying increasing dividends for decades to come, you know, Medtronic is got to be one of the better ideas out there, because they've already done it for decades, and there's no reason to believe, as the company sits right now, that they won't continue to do it decades more, especially with the tailwinds that I noted earlier. So they have 40 consecutive years of dividend growth, and the next thing we talk about is the 10-year dividend growth rate, which gives us an idea of, you know, because it's one thing to say, well, you've been growing your dividend for 40 consecutive years, but if those dividend increases are extremely small, or they're not even matching inflation or something like that, and your purchasing power isn't keeping up with inflation, then it's somewhat for naught. I mean, you want to make sure that you're not just getting dividend increases, but you're getting dividend increases that are sizable enough to matter. And generally, when I say matter, I mean at least at the level of inflation, but, you know, more attractively would be dividend growth that far exceeds inflation, which means your purchasing power is increasing, which means that your options, your opportunities also expand over time. The amount of excess passive income that you have over and above your expenses if you're financially dependent just grows year after year after year, which means that the way you start to approach life, the way you think about money, all that stuff changes for the better for you. So when looking at that, Metronic has grown their dividend at a 14%, I'm sorry, just almost 15% annual rate over the last decade, which you can see right here, 14.7. One thing I like to look at is a deceleration or acceleration in dividend growth, and Metronic's actually been pretty consistent here. The 10 years 14, the 5 years close to 12. I wouldn't really make a note about that. The 3 years back up at 14. The 1 year is coming up at 18. I mean, they're pretty consistent here. The only thing is the most recent dividend increase was 7%, and that's, in my view, really due to there was a large acquisition, which we're going to talk about a little later in the video, that they've had to kind of swallow up and adjust for, and their earnings right now are taking a number of hits due to some adjustments. So that, in my opinion, is not really indicative of Medtronic's future dividend growth potential. It's really more of just well, I mean, first of all, 7%, a 7% dividend increase is, getting back to my point on inflation, well in excess of inflation in the United States. So, you know, nobody should be complaining about a 7% dividend increase. That said, I think their actual potential is greater than 7. I think that's really on the low end, or almost kind of like a worst case scenario for Medtronic's dividend growth looking forward. Getting the payout ratio, of course, we want to know how, because when we start to value the business, when we start to think about, you know, where it's, because we don't invest in where a business has been, we invest in where a business is going yet, right? So when you buy stock today, if you buy Metronic stock today, you're not buying Metronic for what it's been doing over the last 10 or 20 years. You're buying it for what you think is going to happen over the next 10 or 20 or 30 years, right? If you're a long-term investor. And in order to start to kind of build those expectations in terms of dividend growth, which helps us later value the business through a dividend discount model analysis, we need to start to build those future expectations on what we think future dividend growth is going to be. So the first place we want to look at, of course, to build a future expectation, the first thing we want to see is, okay, what have they already done in the past? You know, if a company's been growing at 1% over a very, very long time, to think all of a sudden they're going to grow at 10, unless something radically has changed with the business, doesn't make any sense, right? So the first thing you see is, okay, where have they been over the long haul? Well, we see right now they're growing their dividend at double digits, at a double-digit annual rate over the last 10 years. There's, you know, a minor little bump in the road recently, but the long-term record is pretty strong. They've got 40 consecutive years of dividend increases, and what we're looking at next is the payout ratio, which tells us what percentage of earnings on a GAAP basis the dividend is consuming. And right now that payout ratio is 50%, which actually for me, that's pretty much a perfect harmony between retaining profit for business growth, you know, M&A, whatever it may be, and then sharing that profit with the shareholders, who, as I talked about earlier in the video, are the actual collective owners of any publicly traded company. So when that payout ratio is pretty close to that perfect balance between keeping profit for the business to continue growing the business, and to have options and flexibility with reinvesting back into the company, and then also sharing that profit with the shareholders, saying, okay, shareholders, we earned, you know, X billions of dollars this year. We're gonna cut you a check for 50% of it, and the other half we're gonna keep for the business, because, you know, you don't want all the profit, because we want to continue to grow this business, and you guys want to continue to. You want this to continue to be a very excellent investment over the long term. We want to continue to fund the business for future growth, to write bigger and bigger and bigger checks for many, many more years to come. So you want to see that balance, and that's pretty much right where Medtronic is at right now. That said, when we look at Morningstar's key ratios over the last 10, We can see an increase in the payout ratio, right? So 10 years ago, it was, somewhere around 30% or so, and now it's getting up towards 50%. That said, though, this payout ratio is based off of depressed GAAP earnings due to that acquisition I just noted, which is affecting GAAP earnings because of some adjustments we're having to make, which we'll talk about in the video. That was an acquisition of Covidian, which we'll get into a little bit. The true payout ratio is probably a little bit lower than that. That said, if you want to call it 50%, that's fine, but it's really, frankly, not an issue. It's not an issue at all, because there's no reason why the dividend can't continue to grow at roughly the same rate as a business, which as we're going to show in the video, is a pretty solid rate, which portends very good dividend growth as well. So, and I note here too, the most recent dividend increase was 7%. Although that is half the 10-year dividend growth rate, it's still well in excess of inflation. That's what I was just saying. I mean, nobody's complaining about a stock growing its dividend at 7%. You really shouldn't be anyway. However, this isn't just a dividend growth story. We also want current income, right? I mean, 7% growth is great, but where's the money now? As a famous fictional football player, and Jerry Maguire said, "Show me the money," right? You want money today. You don't just want to, it's bird in the hand versus two in the bush. Well, with dividend growth investing, I want my bird in the hand and I want my two in the bush. I want to have my cake and eat it too. With every stock I invest in, Medtronic's current yield as of the publication of this article, that yield was 2.27%, and I'll show you kind of where that comes from, which is a really solid yield. It's well in excess of the broader market, certainly much greater than you're going to get down at the bank. And frankly, for the industry, it's very appealing as well, which we'll show about in terms, in relative terms, but in absolute terms, 2.27% yield. That's a very nice yield on a high quality stock right now. I mean, can you get higher yield in REITs or utilities and maybe some consumer stocks? Sure, but are you going to make some sacrifices for that? That's something to keep in mind within a diversified dividend growth stock portfolio. So looking at the yield, the current quarterly dividend is 46 cents a share, which you can see right here. On an annual basis, that's $1.84 divided by the current price. We're going to just call it 82 flat. I didn't do something right, sorry guys. So it's a 2.24% yield right now. It was 2.27. So the stock really hasn't moved since I published this article, and it's only been a few days, so wouldn't expect it to move much. So we're just going to kind of continue with that number, 2.27. That's pretty much right where it's at. And kind of talking about relative terms, again, in absolute terms, 2.25% yield is really not bad in this market, especially for a really high quality business like Metronic is, as we'll see. In relative terms, the 5-year average is 2.1, so you're getting a little bit of a boost there in the current yield relative to where it's been over the last 5 years. In terms of what investors have been willing to accept on average over the last 5 years, you're getting a higher yield than that right now, which, as we talked about earlier with undervaluation generally presenting a higher yield due to the dynamic between price and yield, you kind of see that playing out right now. Is it a big difference? No. There's not a massive difference between the current yield and the 5-year average yield. That said, it is a little more income, and we're talking about a market that is hit, what, 80 records or something since the election, 70 records. It broke like 70 all-time highs this year. So when you say, well, yeah, it's only maybe a few, 20 basis points or something higher than its 5-year average, that's 20 basis points higher on a high-quality business, on a high-quality dividend growth stock, presenting in absolute terms a pretty appealing yield in a broader market that is just, on an absolute tear. So you got to keep all that in mind, especially also in terms of interest rates being so low right now. Although they are steadily and slowly rising, interest rates are very low. So like I said, almost relative to anything you can look at it, it's a very, very attractive yield. And you can see the broader market here, which actually I think that's probably a little higher than where it really is. And then you see the industry average here closer to 1%. So you're getting a more than double industry average. You're getting a greater than a broader market yield, and you're getting a greater than the stock zone 5-year average. So I don't know how else you can slice that. It's appealing. So getting into the business growth, of course, in order to determine valuation, in order to estimate the intrinsic value of any dividend growth stock, we of course need to go through a robust valuation method. I use a dividend discount model analysis, and then I also compare that to professional stock analysts and kind of blend those numbers together. But in order to do the dividend discount model analysis, in order to actually use that effectively, you need to have an idea in your mind in terms of what dividend growth to expect moving forward. So we already know what Metronic's done over the long term using 10 years as a proxy in terms of dividend growth, but we don't know yet until we look at it what Medtronic's done in terms of business growth. So that dividend can only continue growing for as long as the business is growing. I mean, if Medtronic just flattens out forever and never grows again, and its profit and cash flow and everything stays static, well, eventually the dividend will stop growing as well, right? So we need to say, okay, well, the dividend's growing at this rate, but where has Medtronic been in terms of business growth, and then where do we think it's going forward? Looking at that payout ratio being a pretty perfect harmony, and then start to kind of draw some conclusions or build some base expectations for future dividend growth. So the first thing we look at is past growth, top line, bottom line, and compare that to a near-term forecast for bottom line growth, and kind of start to meld those numbers together and start to kind of say, okay, Medtronic's kind of right in this range for business growth, which should mean that dividend growth is probably going to be somewhere in that same range, right? Based on the payout ratio being 50%, assuming that Medtronic doesn't want to expand that too much, which I don't believe they do. So we're looking at revenue growth first, and in order to get that revenue growth, we of course have to pull up the last 10 years of annual reports, which I've got the annual report here and you can also pull up Morningstars I've talked about before. They're pretty accurate, maybe 95% of the time when you've got 10-year numbers. And you can see here for fiscal year 2008, fiscal year 2017, as we'll show in the annual reports, the numbers they match up exactly. But you can see net sales right here at 13.515 billion. You see that line up right there. And we will, of course, want to see the starting number and the ending number for the last 10 years. Again, using 10 years as a proxy for the long haul and seeing what we're looking at in terms of top line revenue growth. We can see net sales here at just over 29.7 billion, 29,710. You see the number match up right there. So Morningstar is pretty good for that kind of stuff. But these numbers don't really mean a lot unless we can tell what the growth rate is. We got to look at compound annual growth. So we got to use the first number, 13,515, plug that into a compound annual growth rate calculator. I use Investopedia's, but any compound annual growth rate calculator will do. And we've got 29,710 for the ending number. And of course, we're looking at 9 compounding periods because the first period, the 13,515, isn't a growth period; it's a starting point, right? So you can't actually grow. You didn't grow there; you started there. So we got 9 periods starting after fiscal year 2008. So we've got a compound annual growth rate of 9.15%, which I reflect right here. And that's actually a really strong result. As I've talked about in probably every video, and as I'll talk about right now, I generally look for mid-single digit revenue growth, somewhere in the 5%, 4 to 6% range, somewhere in there. A super mature business, I might kind of bring that down a little bit. And for maybe a slightly less mature business, I might kind of move that up a little bit. So, call it 3.5, 4, something on the low end, and maybe somewhere 5.5, 6 on the higher end. For, again, a mature business, a smaller cap company that's not as mature, I would obviously look for quite a bit more revenue growth. But Metronic has obviously blistered past that number, but that's because of the acquisition, which we'll get into now. They completed the large acquisition of competitor Covidien in 2015 for approximately $50 billion. This complementary addition to the company, with Covidien focusing on endomechanical instruments, adding to Metronic's cardiovascular and orthopedic offerings, boosted the top line in a major way. And you can see that happen, right, guys? So you can see the acquisition kind of come in right about here, and you see 17, 20, 28, 29. You can see that number, jump big. So that's why the revenue grew at such a high rate. Factoring that out, then revenue would have probably been closer to my expectations. So that's something to keep in mind there. So when looking at that, especially when looking at that, really anytime you're looking at a business, this is true, but especially when a company takes on a major acquisition like that, the bottom line growth, especially in relative per share terms over the same period, gives us a better idea of Medtronic's true growth profile. Because you're looking at relative growth, not just absolute growth. The revenue was affected by the acquisition, but when you actually break down how that affected the business on a relative per share basis, after you account for the increase in shares, because they funded the acquisition partially in shares, and you can kind of see that happen right here too, right? You can see the outstanding share count kind of drop a little bit as Medtronic was buying back its shares. 1.1 billion, then you got 1.082 billion, you got a little over $1 billion, and then all of a sudden it jumps up to 1.4 billion here, and they're buying back stock and bringing that back down again. But that was obviously quite dilutive to the business, so you've got to factor that in when you look at relative growth, right? So the next thing we're going to look at is diluted earnings per share. We're starting out at 195, and looking at Morningstar again, they're accurate right there. So we got 195 as our starting point on the CAGR calculator. And then the diluted earnings per share at the end mark in fiscal year 2017 was 289. I think Morningstar is accurate. They are 289. So that's nice to have that. And still 9 compounding periods. That obviously doesn't change. So the compound annual growth rate for GAAP earnings per share at 4.47%, which I note right here. And as I just noted, we see dilution affecting earnings per share growth here because the outstanding share count has increased from under 1.2 billion to almost 1.4 billion. And we also see a dividend that's expanded much further than what EPS growth would usually allow for. So the dividend's grown faster than earnings per share over the same 10-year period. However, and this is a big however, the recent acquisition, which is mostly the recent acquisitions, including Covidien, but mostly Covidien, that's forced Medtronic to log a number of related expenses against GAAP earnings per share. Adjusted earnings per share for the most recent fiscal year, for fiscal year 2017, came in at $4.37. So if we were to look at that adjusted number, and this isn't really a true apples to apples comparison, guys, but just to kind of put things a little bit in perspective in terms of where Medtronic's really at, the compound annual growth rate would have been closer to revenue growth, right? Would have been closer to 10%. And that's really, if we're getting down to the bottom line, if you really kind of take a real close look at Medtronic, which we're not going to go too crazy with it today because I try to keep these videos within about an hour, and if we're going to go crazy with annual reports and financial statements, we're going to be here for hours. We're going to be here all day. And you guys are probably going to fall asleep before it's all done. So that's really quite a bit closer to where Medtronic is really at, if we're being honest about it. And you can kind of see those adjustments play out when we have the most recent annual report here. It's kind of right here. You see this amortization right here, intangible assets. You can see that number jump up big after Covidien came in, and that's really what's affecting GAAP earnings, because operating profit is obviously way down, net income's way down, and those adjustments are really affecting Metronic to a major degree, and that's not going to be forever. And I suspect their GAAP earnings are going to rebound very significantly over the next couple of years, and their price to earnings ratio is obviously going to be affected by that. The payout ratio is going to be affected by that, and all the numbers are going to kind of normalize, to what you might expect from Metronic. Because 4.5% growth, if that was truly what Metronic was doing, guys, this wouldn't be an undervalued dividend growth stock of the week. And I'm a shareholder in Metronic. I would really have to reconsider my ownership stake, my partnership with the company, if that was really where they're coming in at. But it's really not. And looking forward, of course, with every undervalued dividend growth stock of the week article, with every personal analysis I do, with every video, we compare that kind of historic growth rate with what we think they're going to do going forward. And by we, I actually mean CFRA, which is a professional stock analysis firm. And I usually give my 2 cents as well whenever we do these videos and the articles. They're projecting a 3-year compound annual growth rate for the company's earnings per share to come in at 9%. You see that number right here. 3-year projected earnings per share compound annual growth rate percentage, 9%. And again, that's right about where Metronic is at. If you're kind of factoring out some of these major adjustments they're taking, you're saying, okay, earnings per share was really over $4. Diluted earnings per share really came in over 4 if we look past some of these temporary issues. Basically what CFRA is saying is they're saying that they believe that's just going to continue for the next few years. That Medtronic's historic growth rate, what's closer to its true historic growth rate, is just going to kind of continue going forward, and there's not going to be any major change. And Covidien, after Covidien's really fully integrated in the business, which that's currently occurring right now. And once Metronic moves past some of these adjustments and everything, then 9% is where they think it's going to go. And frankly, I don't disagree with that. If we look at the true earnings growth profile of Metronic, the true earnings power of the business, and some of the tailwinds that are going to affect this company over the long haul, 9% is really, in my view, a very, very reasonable expectation for the company. In fact, I wouldn't be surprised if it actually outpaced that number over the next 5 to 10 years. I would be surprised, however, if it came in well under that rate. So looking at that 9%, I think that's very reasonable, if not conservative, looking at where everything is at. So the next thing we get into with the fundamentals of the business is the balance sheet. We look at long-term debt to equity and the interest coverage ratio. Long-term debt to equity, of course, we got to pull up the balance sheet. And just a quick note here, guys, I've got the 2 annual reports for 2008 and 2017 for those fiscal years, and you can pull these annual reports up on Medtronic's investor relations site. I don't show that for the sake of brevity in these videos because it's not real hard to just Google Metronic investor relations. A lot of these videos we usually include links as well, and you just go there and then you click on your annual reports. It just takes a couple seconds. And just while I'm on that topic, you should always be pulling up annual reports, always be pulling up company, 10Qs, 10Ks, whatever it is, the press releases, all the financial statements. You should always be pulling that up straight from the source, straight from a company, because although a third party like Morningstar is usually pretty accurate, it's not always the correct number. You should really be doing your homework and really be pulling up these statements if you're going to be a stock investor, if you're going to buy individual stocks, if you're going to be a dividend growth investor. You should know how to kind of look through these numbers, and you should know what you're looking at and where you're going and everything else. But getting the long-term debt to equity ratio, of course, we're looking at long-term debt, which we see that number right here, which actually bumped up quite a bit because Metronic, they funded that Covidian acquisition through both debt and through shares, so through equity and debt. And so the balance sheet isn't quite as clean as it was, a few years ago. But what we're hoping for, what Metronic's hoping for, what I'm hoping for, what the shareholders are hoping for, what everybody's hoping for, is that the additional growth and the complementary acquisition that was Covidian and the synergies and everything else that should play out over the long term. We're hoping that makes up for any additional debt that's on the balance sheet, and that Metronic slowly but surely starts to pay down some of that long-term debt, clean the balance sheet up and everything else. So getting into that, we've got the long-term debt right here, 25.9 billion. We can see that's actually been that's actually a little lower than last fiscal year, so they are cleaning that up a little bit. And I suspect Metronic historically, when I first invested in them, which was years ago, at a much lower price, and of course value as well, the balance sheet was really spectacular. And it's still a good balance sheet, but it's not as spectacular as it used to be due to what I was just talking about. But getting into that long-term debt to equity ratio, of course, we got long-term debt 25,921. We're dividing it by shareholder equity, which is let me move this calculator so you can kind of see where I'm coming at. So you got total shareholders equity right here at 5294. So we've got a long-term debt to equity ratio of basically 0.51, 0.52, and what I note in the article here should be 0.52. I rounded up, which is accurate. And we've got some cash and cash equivalents up here too. They've got a pretty decent amount of cash on the balance sheet, which is something to note. Nonetheless, though, actually let's just take a quick look at where the balance sheet long-term debt to equity ratio was at 10 years ago, if we want to kind of compare it. We got long-term debt at 5.8 billion and shareholder equity at 11. So yeah, it was actually a little better. The interest coverage ratio probably shows an even better number. Nonetheless, it's deteriorated a little bit, but that was to really take on an acquisition that Metronic believes is going to be hugely beneficial to shareholders, to the company, to the dividend growth, to the growth of the business and everything over the long haul. And so I'm taking them at their word on that. All this said, the long-term debt to equity ratios I've noted in prior videos, as I talk about quite a bit, I don't really put a lot of stock in that, pun not intended. It's a bellwether metric that I include for the articles, but it's frankly just not a number I really place a lot of importance on, because it's basically just how much debt a company has relative to its own net worth, and I don't really see that as a real viable metric, as something that really tells me a lot about the health of a company, because shareholder equity can be affected by so many different numbers, especially companies that are buying back a lot of stock, maybe have treasury stock on the books. It can make a long-term debt to equity ratio look a lot higher than really what it probably actually is. The interest coverage ratio, however, it's a number I really like to look at, and that's basically looking at what the company's ability to cover its interest expenses against EBIT, against earnings before income tax and interest expenses, before taxes and interest expense. So that's basically saying, like, if you were to look at your own personal situation and say, well, my total debt against my total net worth is X, and you might say, okay, well, I guess that tells me something, but you really be looking at, okay, this is what I'm earning, this is what I'm making, and this is how much my debt costs me on a monthly or annual basis based on the interest expenses. That's really a more worthwhile, valuable number. That tells you a lot more about the health of a company from a financial standpoint. And getting into that number, we've got income before income taxes right here. here at 4602, a little over 4.6 billion. We got to add back in the interest expense because that was already deducted in order to get EBIT. So we got 1094 right there. So you've got EBIT of 5.7 billion effectively, dividing that out by the interest expense of just under 1.1 billion. We've got an interest coverage ratio of 5.2, which I note right here, just over 5, and that's a good number. I talked about it before. 5 is kind of a make or break number for me, where I start to become a little uneasy under 5. Anything over 5, I'm generally pretty comfortable with. The higher, the better. All else equal, somewhat. I mean, a company that maybe is way too under leveraged, you can make a case that that's maybe not a good idea, but if I see a number, an interest coverage ratio above 10, say 15, 20, I feel really, really good about that. If I start to see a number under 5, I start to become really uncomfortable. So 5 is kind of that level where I'm like, I want to see a company hold the ground at 5. That's just kind of a number I feel personally really comfortable at, and Medtronic's there. And I suspect that as earnings recover, as these adjustments start to kind of come off, as the acquisition really starts to play out, and as the company starts to pay down its debt, that number is going to improve. So again, this really, when I'm talking about Metronic here, when I'm putting out some of these numbers for this Undervalued Dividend Growth Stock of the Week article, these are almost like worst case scenario numbers for Metronic almost. I mean, these are numbers that are almost about as bad as Metronic can possibly look. So if I were to do this article a year or two from now, the company's going to look way better. So if the price doesn't significantly move up, this is going to be an excellent candidate for an article, 6 months or 7 months from now, if we take another look at the company and see where things are at. But even with all that said, it's still a very, very solid business, even with some of the numbers being kind of affected and maybe looking a little worse. The company not quite having a shine on it right now, if you will. Another number, of course, profitability. We want to see, what kind of profitability the company's registering. And I basically average that out over 5 years, because any 1 year can kind of be really funky. If they took a major adjustment, that might affect net margin or return on equity and so on and so forth. And basically what I'm doing is I'm just averaging the 5 years out. You can see net margin, you can see Morningstar's numbers right here, and you see the numbers kind of take a dip, right? You see net margin in the 20s and now somewhere in the 13s, and that's again because of those adjustments. And you can already see it being boosted back up for the trailing 12 months as they start to clear through some of these issues. Nonetheless, I do average it out, so we're even factoring in some of those issues to kind of come up with our 5-year average. And really, again, this is looking at Metronic without its normal luster. So we got net margin at 15.59% over the last 5 years, and return on equity, we see that number down here. We've got 11.48% right there. These are good numbers, though, guys. I mean, net margin. I mean, if you're looking at Metronic in a usual sense, their net margin is going to be somewhere closer to 20%, which is outstanding in absolute or relative terms, no matter how you want to slice it. Getting net margin is basically what percentage of revenue drops down to the bottom line. What percentage is pure net profit? So if you're selling $100 worth of goods, and you're generating 20 cents of net profit off of that, then that would basically be a 20% net margin, right? So that's a great number, though. I mean, the higher the better, obviously, to a degree. Some businesses out there are generating like ridiculous net margin, like some of the financial services companies, like a Visa, whereas other companies that tend to be middlemen, even in the healthcare space, that tend to be like distributors and things like that, generate much lower net margin. And when you generate a very, very low net margin, you're basically on a volume business at that point. You got to sell a lot of goods in order to make a decent amount of profit. When you got a net margin coming in normalized to closer to 20% for Metronic, that's just a great number. You don't need to do a lot of volume, and frankly, you've got a lot of profit there to share with shareholders and reinvest back in the business and do a lot of things with. Return on equity is again just basically your profit based off of or divided by the net worth of the company, which again, when we talk about return on equity and long-term debt to equity, and you're using any equity numbers, I don't really place a lot of importance on that. Again, I include them in the articles for you guys, but I'm looking at net margin on profitability, and with the company's balance sheet, or with its financial leverage and its wherewithal to cover its interest expenses and stuff. I'm looking at the interest coverage ratio. Okay. So I basically break down the company a little bit here on some of the pros and cons of the company, what we're looking at. You've got some risks, of course, litigation, high R&D costs, ongoing healthcare reform regulation, especially in the US. Those are some of the key risks, but you've also got a lot to like, especially considering those tailwinds. The acquisition of Covidien should just make this company stronger than it ever was before, and it's frankly been an incredible business for a very long time. There's no reason to believe that won't continue, and the true growth rate of the company being closer to double digits on the bottom line is really impressive. So getting into the valuation, the trailing 12-month price-to-earnings ratio was 22.53 when I wrote this article, with the price not really changing much, as we saw with the yield not being affected too much over the last few days. That's obviously still the case. The 5-year average is 23.9. It's currently at 22.53, so a slight discount. And again, that's using GAAP earnings that really are artificially and temporarily lower than they really are, I think. So if we were to kind of factor that in, that difference would be even more advantageous than it looks, as I note right here. And of course, the yield, as we talked about earlier too, is a little bit higher, 2.25, right? Is a little higher than its 5-year average, okay? And price to book is also a bit lower. So there's some metrics in there that are saying, we've got some numbers that indicate some undervaluation. But the key thing I like to factor in is the dividend discount model analysis. That's how I personally value these dividend growth stocks. That's how a lot of investors would value them. And the dividend discount model analysis is frankly just a tailored discounted cash flow model, which is more or less the gold standard for valuing stocks. It's really just tailored for the dividend. You're just substituting cash flow for the dividend. So I think it's frankly an excellent way to value dividend growth stocks. When I did this one, I factored in a 10% discount rate and a long-term dividend growth rate of 8%. So we're going to get into that valuation right now. First thing we got to know is the annual dividend, which I think I just had on the calculator there, but I'm just going to pull it up one more time so you guys see exactly where all these numbers are coming from and everything else, okay? So we've got Medtronic's current dividend at 46 cents a share. That's $1.84 a year. We're putting that right in. I use MoneyChimp's dividend discount model analysis calculator. I actually use, when I do the articles, I actually have like a little custom spreadsheet that works the same as this, but this also works, and you'll see that the numbers match up exactly. And I used an 8% long-term dividend growth rate. And I kind of note my rationale for that right here. It is admittedly on the high end of what I ordinarily allow for, but I do think the stock warrants it. We've got a payout ratio, even against weak GAAP earnings. It's quite moderate. It's actually a perfect harmony in my opinion. We've got a long-term demonstrated dividend growth rate that is extremely high, well into the double digits, and the near-term picture for growth should allow for high single-digit dividend growth for the foreseeable future. Again, if we're saying that Medtronic's true earnings profile is closer to its true earnings growth potential is closer to 9%, on a demonstrated basis, and CFRA believes that they're going to continue that for the foreseeable future, then there's no reason why Metronic can't also grow its dividend at that level and still maintain a payout ratio that isn't expanding. And that's an elevated payout ratio off of GAAP earnings. So once earnings kind of recover back to where they ordinarily are, then you're going to see a payout ratio drop, and you're going to be looking at a company that's growing at maybe 9, 10, 11%. And as I talked about earlier, I think 9% is actually on the conservative side, if anything. So, I'm actually dropping that dividend growth rate in my dividend discount model analysis, even below that, what I think is actually a conservative growth rate for Metronic, factoring in Covidien, factoring in some of the long-term tailwinds of the company, factoring in the demonstrated growth rate, factoring in everything. I think 8%. I don't think there's anything you could say, well, that doesn't make any sense. That's way too high based on this or that. I mean, when you look at the payout ratio, when you look at the earnings growth, when you look at the dividend growth, when you look at the forecast for earnings growth moving forward, when you look at really the whole picture of the business, I think 8% is pretty reasonable over the long haul. Fact, kind of considering that maybe it might be a little higher than that over the next 5 or 10 or 15 years, but there's going to be some flattening out of that over the very long term. But we're 40 years into the dividend growth story, Metronic, and it's been growing its dividend to 14% over the last 10 years. There's no reason to think 60 or 70 years into the company's dividend growth story that they won't be growing that dividend at the high single-digit rate. I really don't see why you would make that argument or how you could. And of course, the discount rate I use in this is 10%. It's not a particularly high-yielding stock, so there's no reason to go any higher than that. So I got a fair value of $99.36, which I note right here, and then I I talk a little bit about in the article why I use the dividend discount model analysis and why I think it works and everything else, which I just talked about. Right here, I showed that my analysis shows a high quality dividend growth stock that is at least modestly undervalued. I don't think the stock is an absolute steal here, guys. As I talked about at the outset of the video, every article is a little different. This is not a deep value play with a ton of risk. This is a very steady Eddie, sleep well at night, high quality dividend growth stock. This is a very strong business that I think is at least modestly undervalued, especially relative to just about, you know, the broader market, the 5-year average and everything else. You're looking at the yield, you're looking at the price earnings ratio, you're looking where the business is probably going to recover to and everything else. However, my analysis is limited to my own perspective, which is why I like to compare my viewpoint valuation analysis to what professional analysts have concluded. And I use Morningstar and CFRA, so we're going to get into that right now. Morningstar's fair value estimate is 97. As we can see right here, they listed as a 4-star stock, which would indicate that it's undervalued. They also, just as a quick note, they note that it has a wide economic moat, which is significant durable competitive advantages. Okay, that's a you know, basically a high quality business. Getting to CFRA's valuation, they have it at 87.23 on a 4-star buy. So we've got two analysis firms concluding 4 stars on this, right, based on valuation. So we've got Morningstar right here, 4-star stock, which we saw, fair value 97, which we saw, and CFRA has it as a 4-star buy, which we saw, and the fair value at 86.36. Was that not different, guys? Let's see. Yeah, they have it as 87.23 right now. And they have this dated as of December 16th, so a few days ago. So this was actually after I wrote the article, because I wrote this article more than a week ago, probably about a week and a half ago. So they've updated it since then. I really don't know why you would update your report and then increase your fair value by, what is this, pennies we're talking? Less than $1? I'm not quite sure why they did that, but at any rate, it's a little higher. I'm not really even going to factor that in. I'm not going to make note of that. It's pretty much the same as it was, okay, as it was a week and a half ago. I don't know why they changed it, to be honest with you. So the fair value I came up with was 94.24. The stock price hasn't really changed too much since then. So that notes that it's possibly 15% undervalued at the time of the article publication, which was just a few days ago. Again, is it a deep value play? No. Is it significantly undervalued? No, but it's a very high quality business, and frankly, the valuation, that you've got a pretty tight consensus across the board. I came in really just a couple bucks away from Morningstar, and CFRA is kind of right in that range too. So averaging the 3 out, you came up with 94.24, 50% undervalued on a market-beating yield, an industry-beating yield, and what could be double-digit dividend growth for at least the next few years. You know, maybe flattening out to that 8% range that I'm talking about in the long-term dividend discount model analysis. My bottom line right here, Medtronic PLC is a high-quality healthcare firm that is positioned extremely favorably in regard to long-term global demographic trends. These tailwinds are powerful, and the company is poised to continue pumping out growing dividends for many, many years to come. With the potential that shares are 15% undervalued on top of a market-beating income, this is a compelling long-term dividend growth investment idea in the healthcare space. So, you know, I think that's a fair conclusion, a fair analysis on Metronic's quality of business, on its fundamentals, and on its valuation. And just as a note here, Daily Trade Alert also includes a dividend safety score from Simply Safe Dividends. As the article went to press, that score was 98, which you can see here is a very safe dividend. If I could think of 10 stocks that are bulletproof dividend, that are going to be bulletproof dividend payers for the next decade, you know, saying I would bet, you know, a significant amount of my money on this stock definitely continuing to pay dividends for the next 10 years and growing those dividends, Medtronic would probably be on that list. I mean, it's a wonderful business. That dividend is extremely safe. So if you're relying on this company to pay you not only a dividend, but an increasing dividend year after year after year, and you're kind of betting your retirement on it or using that passive income to pay your bills like I am, this is one of the better businesses out there for that purpose. So that's it, guys. That's the video. Hope you enjoyed. Again, as I talk about in every video, it's a real honor. It's a real pleasure for me to be able to present these videos to you guys, to be able to kind of walk you through everything. I live and breathe this stuff. I love this stuff. My life depends on this stuff, if you will, because if something were to happen significantly to my passive income, then where does that leave me in terms of my lifestyle and everything else? I do write, I do these videos, and I do a lot of my work, if you want to call it that, for the pleasure of it, really more than anything else. But my lifestyle is the foundation of my life. If my life is a house, the foundation of that house is that passive income. So if that passive income were to somehow dramatically dissipate or disappear, then the foundation starts to crumble. So my life essentially depends on this stuff. So it's a true pleasure of mine. Whenever I start doing these videos, I get pumped up with energy, and I'm ready to just talk for an hour straight, which is about what these videos run. So again, thanks so much for following along, guys. Hope you enjoyed the video today. Hope you have a wonderful day. Thanks so much. Bye-bye.